Next, we move on to the valuation methodology. Here we discuss the methodology that is used to value the employee benefit liabilities. As per the accounting standards, Ind AS 19 or AS 15, the most prescribed methodology is the projected unit credit method. This is also called the accrued benefit method. The method calculates the present value of projected accrued benefits as on the valuation date. Now, the PUC method, it works by allocating the total expected benefit cost over an employee's working life. It essentially considers each period of service as a separate unit of benefit entitlement and value them individually based on the current salaries or service of the employees. This ensures that the cost is accounted for in a systematic and fair manner, which aligns with the financial reporting standards. This is also illustrated by the timeline at the bottom of the slide, which represents the expected future cash flows year 1, year 2, year 3, year 4 until the retirement of the employees. We have also considered two critical assumptions, the salary growth rate and discount rate assumption. For each expected cash flow in the future, we increase the cash flows with a salary growth rate assumption, and we discount all of these cash flows with a discount rate assumption to the current valuation date. So the PUC method is an internationally accepted approach that aligns with the accounting standards, ensuring a fair allocation of benefits across an employee's service period. By carefully selecting the actuarial assumptions, organizations can accurately project their long-term liabilities and ensure financial preparedness for employee benefit payouts. Here, let's talk about a simple benefit structure that we can consider for a simple gratuity plan. It captures essentially the key things that are required in any gratuity valuation. First is the salary used for the gratuity valuation, which is the last drawn basic salary. Then we have a normal retirement age for the company, which is 60 years. We have a vesting condition of 5 years that states that any employee who needs to be eligible for a gratuity benefit needs to have a minimum of 5 years of service in the company. Next, there are certain sorts of separation that the employee can separate from the organization. It can either be through retirement, resignation, or death. In any of these cases, the benefit is payable as per the Payment of Gratuity Act. However, in case of death, there is no vesting condition that is applicable. Even if the employee has not rendered 5 years of service, the benefit that has been accrued to the employee for the service years that he has rendered to the company is still given. We have also considered a limit of 20 lakh rupees, although the companies can pay or can consider a limit which can be higher than this, depending upon the company's individual gratuity policies. So as per the Act, the gratuity formula is 15 by 26 into the last drawn basic salary into completed years. This states that the employee will receive 15 days of last drawn salary for each completed year of service. So we have now considered an example of one of the employees. The employee's current monthly salary is 55,000. The current age of this employee is 40 years. The retirement age is 60 years. The completed years of service that this employee has rendered to the company are 13 years. By this, we calculate an accrued liability. So accrued liability is data-driven. It can be calculated using the gratuity formula, which we have just discussed, which is 15 by 26 into the monthly applicable salary into completed years of service. So this does not incorporate any vesting criteria or any of the actuarial assumptions. So the value of the accrued liability in this particular case comes 4,12,500. Now, in order to calculate the actuarial liability, as we have discussed, that we use a projected unit credit method. In this case, the employee's current age is 40 years and the retirement age of the company is 60 years. So the employee still has 20 years of service until the retirement. We will now be estimating the future cash flows for the next 20 years until the retirement of this employee. And for each of the future cash flows, we increase the cash flow by a salary growth rate percentage. We increase the salary by a growth percentage of 7.5% in this example. And we discount back all of the future cash flows of the 20 years by a rate of 7%. So the actuarial liability is calculated towards the right of the slide, which has been calculated using the accrued liability, which is the base data, into the projected salary increments and using the discounting factor for 20 years, which gives us a liability which is slightly higher than the accrued liability. There can be a sense check that can be considered here in order to get a relationship or to calculate how much the actuarial liability varies from the accrued liability. This is called the ratio. So the ratio in this case is somewhere about 110%. This can also be validated through a sense check that the salary growth rate assumption is slightly higher than the discount rate assumption by 0.5%. And we are projecting the liabilities for the next 20 years. So somewhere the liability might be 10 to 11% higher than the accrued liability. Again, for simplicity, we have not included any mortality or attrition rate assumptions in this scenario, but the same play a crucial role in calculating the liability figures, and accordingly, the ratio or the relationship between the actuarial and accrued liability can vary due to different other reasons as well. Next, we move on to the valuation results. So now that we have seen how a simple gratuity liability is calculated, let's understand how it's reconciled in the financial statements under Ind AS 19. So the table here shows a reconciliation for the period ending 31st March 2024. The present value of obligation as at the beginning is the liability as on the opening valuation period. Throughout the period, there are different components that are included in order to compute the closing liability figure. I will just walk you through the individual components, what it means, and where are the expenses recognized. So the first component is the current service cost. So this reflects the cost of additional benefits earned by the employees as they complete another year of service in the organization. This component is recognized under the income statement. Second component is the interest expense or cost. Since gratuity is a long-term liability, it grows over time due to the passage of time. This increase is recognized in the income statement. This is calculated using the discount rate assumption on the opening liability figure. The third component is the remeasurement of actuarial gains and losses. So this arises due to the change in assumptions or the unexpected deviations in actual experience, and the same is recognized under other comprehensive income. The key factors under the remeasurement of actuarial gains and losses is first the change in demographic assumptions. So it can be any change in mortality rate or attrition rate or retirement age. The second is the change in financial assumption. This captures any change in the discount rate or salary growth rate assumptions. The third is the experience variance component. So this basically reflects the difference between the actual events and what was previously assumed. The next component is the past service cost. So this occurs when there is a change in the plan benefits, either an enhancement or a reduction, which impacts the liability immediately. Next component is the benefit payout. This is the amount that is payable to the employees who have separated from the organization from the opening till the closing valuation date. Then finally, we have the present value of obligation as on the closing valuation date, which is 31st March 2024. Similar to this, we have the reconciliation of plan assets under Ind AS 19 for the period ending 31st March 2024. Again, we start with the fair value of plan assets as at the beginning of the period. Then we have an important component called the investment income. This is calculated using the opening discount rate assumption of the opening plan asset value. This is the key component which is recognized under the income statement. The next component is the contribution. This is the amount that the companies contribute into the fund during the valuation period from opening to closing. Then we have the payment. This is again an amount that is withdrawn from the fund from the opening to the closing valuation period in order to pay to the employees who have separated from the company, be it either because of retirement, death, or resignation. Now, an important adjustment is another component, which is return on plan assets. This is the amount excluding the amount which is recognized in the net interest expense. This basically represents the difference between the actual return and the expected return on asset. This is recognized under other comprehensive income. Then we finally have the fair value of plan assets as on the closing valuation date, which is 31st March 2024. So to summarize, we have the components bifurcated under income statement and OCI. The income statement components, as we have discussed, are the current service cost, the past service cost, and the net interest cost, which is the net of interest cost on liabilities and income on assets. In the other comprehensive income, we have the overall actuarial gains and losses, both on liability side and on the assets. Now, when we talk about the actuarial valuations, people often solely focus on the final liability figures. But there's definitely more to it. The real value lies in the insight we gain from the process. So here we talk about some of the key aspects of actuarial output that go beyond just the liability figures, and we explore how they contribute to better analysis and strategic planning. So the first one is the reporting. So one must definitely review the key data, the assumptions, and the benefit structure. And one should do that to ensure that the calculations are based on reliable and accurate information. Also, the validation of liability figures is essential to check if they align with the expectations or not. The second is the employee-wise liabilities. So transparency at an employee level gives great confidence in the valuation results. It can also help the companies to track the workforce movements. For example, there are certain scenarios wherein there are certain transfer cases from one entity to another within a group. The third, we move on to the comparison of actuarial and accrued liabilities. So this we have also discussed in the previous few slides. Again, it is a great way to check on the actuarial valued liability and if it makes sense or not. Further, we can also trace it and compare it to the year-on-year liability figures to find consistency and accuracy in the valuations. In case there are a significantly large deviations, reasoning can also be checked through. Fourth, we have the experience variance and the sensitivity analysis. Experience variance, again, it helps us to understand how accurate our initial assumptions were, if actual experience significantly deviates from what we had expected. Also, the sensitivity analysis allows us to see the impact of change in assumptions in the actual liability figures. Now, actuarial valuations involve multiple stakeholders, each playing a distinct role to ensure actuarial financial reporting, compliance, and liability management. In this slide, we have summarized the roles for all of them. So the first is the data. Data is generally provided to us by the company. The actuary and the auditors can check the accuracy of the data. Second is the assumptions. So the actuaries can advise on the assumptions to be considered for the valuation. The companies are to confirm and finally decide the assumptions that need to be considered, and the auditors do concur on that. Third, we have the valuation results. So the actuary is responsible in providing the valuation results to the companies. The company and the auditors rely on the results provided by the actuarial team. Fourth, we have the disclosures. The actuary provides the disclosure certificates to the companies. The company discloses it in their financial statements, and the auditors again concur. Then we have the liability management. So the actuaries assist the companies in managing the liabilities based on different scenarios if required. The companies manage the liability figures and conclude on the same. So this is primarily overall the role of the stakeholders.